Open the three-part rule. The familiar phrase FDIC insured up to $250,000 is incomplete. The standard amount is $250,000 per depositor, per insured bank for each account ownership category. Those three parts decide how deposits are combined. This field guide explains the rule, what counts as a deposit, how common ownership categories work, and what happens when an insured bank fails. It is finance education, not financial advice. It gives no personalized recommendation, guarantee, live trade, fake trade, or performance result. Any dollar example is hypothetical. Chapter 1, start with a bank. FDIC insurance applies automatically to eligible deposits at an FDIC insured bank. A customer does not buy a separate policy or file an application when opening the account. But a familiar brand name, app, branch, or product label does not answer the legal question. The institution holding the deposit must be insured. Use the FDIC official BankFind Suite to verify the bank and its certificate. Separate branches of the same insured bank are not separate banks for coverage. Deposits at separately chartered insured banks are calculated separately. A financial technology app may place customer funds at one or more partner banks, so the account agreement and the bank records matter. Chapter 2, deposit or investment. The FDIC insures deposit products. Common examples are checking accounts, savings accounts, money market deposit accounts, and time deposits such as certificates of deposit. It also covers certain official items issued by a bank, including cashier's checks and money orders. The FDIC does not insure stocks, bonds, mutual funds, crypto assets, life insurance, annuities, municipal securities, or the contents of a safe deposit box. A product can be sold inside a bank building or shown inside a banking app without becoming an insured deposit. The useful question is not, where did I buy it? But what legal product is it, and which insured bank holds it? Chapter 3, ownership category. All deposits owned by the same depositor in the same ownership category at the same insured bank are added together. Opening more checking accounts, savings accounts, or certificates of deposit does not create more coverage when the ownership category stays the same. Imagine one person has a hypothetical $180,000 in savings and $90,000 in a certificate of deposit at the same insured bank. Both are single accounts. The combined single account balance is $270,000. Under the standard limit, $250,000 is insured and $20,000 is above the insured limit. This is a teaching example, not an actual account review or recommendation. Different ownership categories can receive separate coverage when every requirement is met. Common categories include single accounts, joint accounts, certain retirement accounts, trust accounts, employee benefit plan accounts, business or organization accounts, and government accounts. The category is a legal ownership capacity, not a marketing label. Chapter 4, single, joint, and retirement. A single account is owned by one person without beneficiaries. The FDIC combines that person's single account deposits at the same insured bank. A sole proprietorship account is generally added to the owner's other single accounts rather than treated as a separate corporation. For qualifying joint accounts, each co-owner's share of all joint deposits at the same bank is insured up to the standard amount. Joint ownership has specific requirements, including equal withdrawal rights unless state law limits them. Merely adding an authorized signer does not necessarily create joint ownership. Certain retirement deposits form another category. This can include traditional and Roth individual retirement accounts and specified self-directed retirement plans when the assets are deposit products at the insured bank. The retirement account label does not make stocks, mutual funds, or other investments FDIC insured. Chapter 5, Trust Accounts. Trust account rules were simplified effective April 1, 2024. Revocable and irrevocable trust deposits are now calculated under one trust accounts category. In general, coverage is based on the number of eligible beneficiaries, with $250,000 per eligible beneficiary, multiplied by the number of trust owners, up to a maximum of $1,250,000 per owner at one insured bank. If a trust owner names one eligible beneficiary, the maximum for that owner is $250,000. Two beneficiaries can support $500,000. Three can support $750,000. Four can support $1 million. Five or more reach the $1,250,000 cap per owner. Those are maximums, not promises that every trust balance is covered. The bank's deposit records, the owners, the beneficiaries, and the rule requirements all matter. An informal payable on death account must identify its beneficiaries in the insured bank's records. Complex trusts, changing beneficiaries, or unusual terms deserve verification with the official estimator or an FDIC deposit insurance specialist. Chapter 6, Pass-through and apps. Some deposits are held through an agent, custodian, broker, or financial technology company. Pass-through coverage can protect the underlying owners when regulatory requirements are satisfied. The relationship must be disclosed in the bank's records. The identities and interests of the owners must be ascertainable from required records, and the deposit must qualify under the ownership category claimed. Pass-through insurance does not increase the standard limit. It can attribute the deposit to the actual owner, whose other deposits in the same category at that bank are then combined. It also does not protect against every failure outside the bank. FDIC insurance applies when an insured bank fails. It does not insure an app company's bankruptcy, fraud, operational outage, or loss of records. Chapter 7. When a bank fails. When an insured bank closes, the FDIC acts as insurer and receiver. It generally seeks to give depositors prompt access to insured funds, often by transferring deposits to another insured institution or making payment directly. Insurance includes principal and accrued interest through the date of the bank's closing, up to the applicable limit. Amounts above the insured limit are not automatically insured. A depositor may receive a receivership claim for uninsured funds and could recover some money as the failed bank's assets are sold, but the amount and timing are uncertain. Deposit insurance protects eligible deposits against the failure of the insured bank. It does not prevent investment losses, identity theft, account fraud, or ordinary disputes with a functioning institution. Chapter 8. The Coverage Worksheet. Use a 6-step worksheet. 1. Identify the insured bank with BankFind. 2. List only deposit products held there. 3. Identify each legal owner. 4. Assign each deposit to its correct ownership category. 5. Combine deposits for the same owner, bank, and category. 6. Verify the result using the FDIC Electronic Deposit Insurance Estimator, especially for trusts, retirement plans, businesses, and pass-through arrangements. Do not treat a branch as a new bank. Do not treat a new product type as a new ownership category. Do not count an authorized signer as an owner without checking the records. Do not assume that an app's logo identifies the bank holding the deposit. And do not rely on a social media chart for a fact pattern that depends on legal title and beneficiaries. Close, verify the records. The durable rule has 3 parts: depositor, insured bank, ownership category. Start with the institution, separate deposits from investments, then aggregate the balances that belong together. The official FDIC estimator and current account records are better tools than a slogan. This program is finance education, not financial advice. It contains no personalized recommendation, current offer, forecast, guarantee, live trade, fake trade, paper result, or performance claim. The hypothetical examples explain coverage mechanics only. Current rules and institution status should be checked on fdic.gov and in the Electronic Code of Federal Regulations. Sources were verified July 26, 2026, and are listed in the description. The visuals are original synthetic motion graphics, and the narration uses the artificial AF heart voice. Clean procedural ending audio continues through the final frame.